How's it going, everyone? Mark Anderson here, construction worker turned zero DT hedge fund manager. Today, I wanted to go over basically stop losses a little bit and some concepts behind it. It's predominantly in regards to this article. I will link it below from Ewan Sinclair. He's written Positional Option Trading. It is extremely good, and I enjoy everything he writes about. Basically, at its core, we're going to go over some concepts, but this shows a normal distribution or basically a bell curve with trades without stop losses. Then this shows basically how the distribution could be changed from these stop losses. So as we're deep diving into the hidden truths around this and stop losses, orders and trading, an essential tool that can significantly impact your trading results. Let's first clarify basically what these orders are and the instructions to your broker to sell at a certain price. The goal is basically to limit those losses and manage your risk. It sounds simple. However, there's much more beneath the surface. The common perception is by using stop loss orders, you can avoid going broke by cutting losses, like cut your losses and let the profits run and are frequently tossed away. But does this really hold true? So let's explore kind of some of the complexities around this. The first thing in regards to using stop losses is you have to understand, do you have an edge and is it a solvable problem? Essentially, we're taking the stance when we're selling credit spreads, especially in zero DT, that the edge is from the volatility risk premium, that we wholeheartedly believe it exists. The other problem is we can't blow up and we have to last long enough and create enough occurrences to realize this volatility risk premium. We know one thing is a very simple truth, that the volatility risk premium is at its max at entrance, and the only way we can guarantee we realize this is by holding its expiration. However, any management that we use in terms of entering the trade, exiting the trade, slippage commissions, and fees will reduce our overall premium capture over time. However, it will also change the shape of our distributions similar to this. So the real question is, when we're changing this, does changing the size and the look of that distribution benefit us more from our ability to compound comparative to our ability to recover from losses? So this article basically touches very quickly with that. With 10,000 pass of a simulation, the average return is 10% without stop losses, and the return is 8.8% with stop losses. So you could say that although we cap our losses, we do in turn lose profit, but does that basically help us? So the hidden cost of these stop losses is basically we lose a lot of small wins because stops can't prevent small trades from hitting their potential, and we change the return distribution, and the stops alter our return profile, creating a different distribution with lower expected returns. And not having those small wins and taking more small losses can add up rather extensively over time and could make a massive difference when it comes to zero DT trading. So a huge benefit of stop losses that we may not be able to quantify mathematically is that they limit our losses and enforce us to use discipline. So we have much less of a chance to behaviorally make a mistake by doing things. And we always have a rules-based approach of what our risk is. Thinking critically behind the reasons that we're using a stop, however, is very crucial. And one thing that opened my eyes in this article was basically saying that stops are a form of trend following, because if we put on basically a delta neutral condor, we say, oh, we're not choosing direction. But if we take off one side at a 1x stop or a 2x stop, we're taking the stance that we don't think there's going to be mean reversion and that trend's going to basically continue. So understanding the benefits of these stop losses is they also serve as these trend following indicators like we've spoken. And there's a lot of utility to that, and it has a vital role in risk management as well as trend following strategy development as well. So it gives us a potential for early exit, because as much as stops help in risk management, they can also lead to being stopped out of potential profitable trades that essentially in volatile markets will hurt us on large up and down swings. So that's opposite of mean reversion and can hurt us. Then the other benefit and how it reflects to trend following is that in changing market conditions, markets are not static, and the trending behavior can obviously shift based on participants of the market. So using stop losses accordingly works as a actual reactive mechanism to what's going on in the market, even though it is systematic. So we are dynamically adapting to the market. Also, by reacting to the market movements and these triggering to exit a position, whenever the market's behavior changes for any reason that we know or not, this reactive nature of the hallmark of trend following, where our decisions are often based on the current market trend rather than about future price movements, which makes sense because our risk is in the current market trend. Also, behavioral bias, when stuff goes up, the Trump trade, there's momentum. It keeps us in trending markets, which is the best time to trade. So that's all beneficial. And always to leave you guys with something is I wanted to show you kind of what I would consider a stop loss trending trade. So this trade is basically taking $1.70 on each side about every 15 minutes into the close. I did cap the max fix at 25. We have a 75% stop loss on each side. Again, we got to use 10 cents of slippage at the beginning because 5 cents to cross the bid ask on each of these orders because it looks separately. And then I used 5% of the bid ask spread to basically leave at the stop price. So the stop price is around $3, which will put us basically exactly at 15 cents. So you can see it looks relatively good. I did filter out that max fix. However, this, at its core works. But I do want to highlight how fragile of a trade this is. And, even though the S&P does have down years, you may just be better off because you don't really have a chance of ruin of buying like a 2x levered ETF of the SPY or something, because we are using options and leverage here, and we are buying back the short leg, which can lead to relatively large slippage. To show you how fragile this trade is, even though it's a type of trend following, is if we were to now do 20 cents of slippage, which is relatively reasonable in a 2-leg order potentially, that's how I would actually phrase it, is all of a sudden we go from 5.6 premium capture and 127 grand return to 91 grand return and a 4% premium capture. The next thing is I would also be hesitant about running this if you don't have some type of mechanism that can check the bid-ask spread. So now if we get rid of basically ignore wide bid ask, because if you're being mechanical, you would be taking these unless you had some type of filter, all of a sudden we go down to 3.7% premium capture. So I'm not saying that this is really a bad trade because it's really good at managing your risk. It's just not good at making money. And it clearly, works over a period of time. But if we have a little bit more ability to automate things and can check things, you can see that there is money to be made potentially with this trade, and there are no filters on it. So it being a capital efficient trade, I think it could have a small piece in a portfolio, maybe selling 20 or 25 basis points a day. The next thing I'd like to share is David Sun made this, but it's actually an expectancy simulator. So this basically shows if we have our projected win rate of 50%, I'll try and squeeze in on this a little bit. And then we have a profit target of 100% because that's what we'd be winning on this trades. And then I put a stop loss of 85% because again, we have a 75% stop loss. However, with the slippage, it amounts to close to 10%. Of the entry premium or 5% of the exit premium when that happens. So you can see here, you potentially have an 8% premium capture if everything goes right. But I want to show how wonky this can be over 10 occurrences. Then if we go over 100 occurrences, you can see it goes quite up and down. And then maybe if we go to 1,000 occurrences, you can basically see how much it can change over those periods of time and, drawdowns as well. So again, this trade, very good at not losing money. You can see the drawdowns, but I think this is a good way to kind of quantify what backtest could look like without using backtested data, just from a risk to reward perspective. And let's say we got more slippage, all of a sudden, a route can look significantly different. So if our stop loss goes from 100% to 85%, our return looks drastically different. So you could tell from this trade, even though this may look good, that there could potentially be an incredible amount of risk that this won't work if you just get slightly higher stop losses. So I'll link this in the description. I recommend people play with it, but you can just see how bad the returns can double and triple and how quickly this can occur just by getting 5 to 10 cents more slippage in certain things. And this is extremely important with 0DT trades because we create, I think this trade had 15,000 occurrences. And all of a sudden, if you're trading a trade that can lose money, this is very sketchy for something you would potentially trade. And at its core, a lot of people are trading this. And what I like to say with this trade is you're not really making money off volatility risk premium. You're kind of more just making money off the broker executing well, which definitely makes sense why that would get overcrowded over a period of time. But I do, like to share that I think this trade will make money between 2.5% and 5% premium capture, but it's a very small overlay over like holding the S&P or holding fixed income that could make sense in a portfolio. So if you have any questions, feel free to hit me up, but I recommend you guys run some of your back tests through the simulator. Other thing to note is that if you left out entries with filters, like you only trade Fridays or something, I definitely add, 10 to 15% to your potential win rate going up or down just because you're filtering out so much data. But what I'm trying to do is just show mathematically and with real trades kind of how these concepts can affect our back testing and how we can apply this best to create the portfolio that can make money for us. So appreciate you guys. If you like this, share it with anyone. It's the highest compliment to me. And I will talk to you guys later.